This morning on BRN, why consider long-term care insurance? Joining me now to discuss this and a lot more, Phillip Snyder is with the Warner Companies. In full disclosure, he's also my dad. Dad, great to see you. Thanks for joining us on the program this morning.
Oh, good morning, Jeff. Good to be with you as usual. Thank you.
Yeah, it's always great to talk to you. It was great to see you in Washington, D.C. at the Spark DeCia Public Policy Forum recently. So thanks for coming down from good old Baltimore.
Oh, it's always my pleasure. And a lot of nice people there, and I know you had a chance to renew your relationship, so that's
Yeah.
great.
Yep, a lot of good information there for those who didn't go. Check it out, certainly. All right, Dad, I want to talk about a couple of things with you, long-term care being one, but I thought I'd start with interest interest rates because there's a lot of talk about the Federal Reserve possibly lowering interest rates. There's been a lot of pressure from the White House. There's been a lot of concern about bonds and the Treasury yields. Is there a correlation between interest rates and the insurance products that are being offered to the public today?
Well, I guess you're referring mostly to life insurance products.
Yeah, typically life insurance.
Yeah, I would say, well, there's definitely a correlation, but not as direct as you might think. Most policies that are being sold today are called flexible premium policies, or universal life is the more common term. Many of those are products that credit interest based upon the portfolio rate of return of the insurance company. So clearly, there's a correlation between what insurance companies can earn and what they can credit. Um, but it's not a direct correlation because the insurance company's portfolio turns over time. So as a portion of the portfolio matures, and the funds that have matured then have to be reinvested. If they're reinvested at lower rates of return, for example, it's going to have an impact, certainly in the longer term, upon interest rates credited to the policy. So that's one simple example. Uh, Clearly, insurance companies are looking for other sources of revenue through some subsidiary companies and things of that nature to boost their interest rate. So it's a constant, I don't want to say battle, but it's something that needs to be watched, not necessarily by the policy owner or the consumer, because the individual who owns the policy or the company or whomever owns the policy uh, has no real uh, impact upon the rates that are credited if it's an interest-bearing account. There are other kinds of life insurance, not to belabor this, where you don't necessarily rely on interest crediting, where you may have sub-account investments and things like that. So there's clearly an impact in the longer term.
And and that's
Plus or minus.
and that's where independent rating agencies, Moody's, Fitch,
Sure.
S&P, AM Best, they come in to look at the underlying investments that you're referring to, the bond holdings, the other investments, to ensure that the organization can pay claimants if they have enough to pay claimants over time.
Well, sure. I mean, there's always a financial rating from some of the companies' rating services that you just mentioned and others, for example. If I'm a consumer, I would try to buy my permanent life insurance products, certainly my cash accumulation type products. I want to buy them from the most highly rated companies, which are rated through these various agencies. And you can sort of figure out what quintile or percentile those companies are versus the ideal. And you want companies that are most highly rated, and that's many of the larger companies, and of course, there are smaller companies as well. So I would look at that clearly. I
Yeah,
wouldn't
a
I
very
wouldn't
important
want to
issue.
buy something from a low rated company.
Yeah, because there's just more risk involved, and are your premia actually going to be returned if you have a claim? All right, let's switch gears. And recently,
Sure.
within the last couple of weeks, I've done a lot of shows on long-term care planning, long-term care needs, and one show in particular with the University of Michigan Health, they did a survey. I think somewhere a large percentage of adults my age and over, so 50 and over, are underestimating their long-term planning needs. Does this come as a shocker to someone like yourself who is knee deep, up to their neck in these types of discussions?
No, not at all. It's been my experience the same as you're relating. Um, yeah, that's kind of the attitude that it's an old, it's going to happen only to old people. And I've got a lot of time. I've got other priorities ahead of that, for example. And there's some validity to that type of thinking. On the other hand, you probably want to be, if you're going to buy product or you're going to set aside money to fund these potential, let's call them, not probable, but potential expenses downstream, which can be very, very large. We could potentially be talking about big numbers. I probably would want to do that during my working years, where I have a consistent income coming in, rather than trying to fund these things post-retirement, because where my income is certainly lower than it might have otherwise been, typically, not for everyone, but typically lower than it might otherwise have been while I was employed. So that's kind of the catch 22, as it were. Um, but this happens all the time. I would say probably you see all kinds of statistics, but the likelihood of having a long-term care need is probably 55, 60% of individuals over age 65 will incur some type of long-term care need, where they'll need services, whether that's standby assistance at home or in a nursing home or whatever. All those things are very, very expensive today, and only going to increase significantly in the future. So you really should be planning and thinking about that, even if it's a little lower on your totem pole today.
And there are a lot of myths and maybe misconceptions about what pays for what. And I'm talking about Medicare and Medicaid. I think a lot of people are under the impression that Medicare will cover some of these expenses, like supporting somebody in their late years at a nursing home. That's not the case.
Not at all. There's some limited coverage. Um, Post-hospital stay, for the most part, there's a limited number of days of coverage, but by and large, the coverage under Medicare is very limited, very limited. You can't really look to that to fund long-term care expenses. Um, if you Medicaid, well, of course, there's a lot of talk in Washington now about Medicaid, refining Medicaid. Medicaid is really, or was, I guess, at this point, being readjusted at this point. But Medicaid was really for those who didn't have significant assets and couldn't pay their way for this type of care. It's gotten expanded because the eligibility rules have broadened, or I don't know if the rules have broadened, but the interpretation of the rules has broadened. And so we've got a lot of people who are using Medicaid money, who probably should never be receiving that money, because under the original guidelines, they were not eligible. So you
Right.
can't really look to Medicaid necessarily, and you surely can't rely on Medicare. You really have to look at yourself and what services and what family members may be available to help and things of that nature, and what monies you're going to need downstream. You don't have to fund 100% of it, but you want to have money available in the event those kinds of expenses are incurred, because they can be substantial. I would say, looking out 20 years, if someone needed care for 5 years, you're easily talking about $500,000, depending on,
Yeah, I mean,
and up, depending on,
yeah,
and that's a lot of money for the average person to take out of their
absolutely.
retirement funds.
Absolutely.
So
Uh,
you got to think
are,
about that.
Absolutely. Are you seeing more employers, and I apologize because we're going to have to wrap up this episode in a few minutes, but let's talk about employers, because forgetting we've talked with you about the individuals going out and buying their own policy, but are more employers looking at this benefit and saying, for the rank and file, I'm not talking about executives, I'm talking about the rank and file, are they making this available, and what should they be thinking about to make this type of product available to their rank and file employees?
There are products available and employers are looking at it. I don't think it's that extensively used or employed at this time, but more and more seem to be interested in it. Employers don't necessarily want to fund it. They want to make it available on a voluntary basis. And there are plans like that where you can get some level, maybe not as much coverage as you want, but you can get it on what we would call a guarantee issue basis, which means there's no medical underwriting requirements to get the coverage. So the answer to your question is yes, but not as extensively as we think it should be.
Yeah, I was going to ask you, let's close out on why you should as an employer. I can think of a couple reasons, but I'm not the expert in this particular area. You are. Why should you offer this as a voluntary or some type of benefit, regardless of if you're a big corporation that self-funds its insurance or its health insurance, or a smaller enterprise like a small business offer this product?
Well, it's conceptually, it's probably the same rationale as why you offer a 401k plan, for example. And employers offer 401k plans and don't necessarily put a lot of money into them on behalf of their employees, but they make the pre-tax contributions available because they know people are going to need money downstream in retirement, and they're creating a tax deferred mechanism to accumulate money. Well, conceptually, it's the same thing as long-term care. If I potentially have a need downstream, then I can make available a product that could help people offset some of that cost.
Yeah, and in a workforce that now has multiple generations. It's got my generation, it's got your generation, it's got the generations that are following ours. It's I think for the first time in American history, we've got 4 or 5 generations that are currently working. It's needed. It's a multi-dimensional, and people are going to be caregivers. People my age are going to be caregivers for their parents and those that follow me.
Yep, I'm counting on you, incidentally.
You are, and you should. And Andy and I will be there for you.
But
Yeah,
in all seriousness, it needs to be factored into your discussion. How you deal with it, whether you use insurance products, whether you just create an investment account of some sort to fund it, regardless of how you do it, or you do a little of each, whatever works, you should be thinking about it. How am I going to pay for these things, and who's going to be available to help me downstream? Because obviously you and your younger brother don't live where I live. So you're not going to be there to provide services. So I'm going to have to give consideration to that as well. So those are just a few of the things that you have to take into account.
and I wouldn't rely on the government to do it either, by the way. Dad, we're going to have to leave it there. It's always great to see you. Thanks for sharing your insight and experience. We look forward to having you back on the program again
All right, Jeff, my
very soon.
pleasure. Thanks. Have a good day. Bye-bye.
And don't forget to subscribe to our daily newsletter, The Morning Pulse, for all the news in one place. Details, of course, at our website. And your subscription helps support all this great BRN content. We're back again tomorrow for another edition of BRN. Until then, I'm Jeff Snyder. Stay safe, keep on saving, and don't forget, what would you change?